All right, ladies and gentlemen, welcome to the FOMC Prep with your host, Tony. I'm also the head financial analyst at FinancialJuice. We've got a lot to cover with this one here. All right, so we've got about an hour to go till we get the rate decision. We need to go through the sentiment, what it means for the markets or could mean for the markets, the kind of things to look out for, and then what is the sentiment from the investment banks as well. So don't forget, if you've enjoyed the videos in the past, to give the video a like and share and subscribe to the channel as well. If you're new here, then take in the information as best as you can. If there are any little bits, I'll try and cover off those bits if you still have questions. And yeah, but let's get into it, and let's start off with what is the interest rate decision. So first of all, we've got to bear with me 1 second, people. Okay, so I am back. All right, apologies for that. So yeah, so first of all, we've got to define what is the interest rate decision and what is it all about. So it's a meeting of the FOMC members, roughly every 6 weeks, over a 2-day period. And that's where, of course, they set the federal funds target rate and policy. That's very important because it's, of course, first of all, it's the rates it's the rate the banks charge each other to borrow or lend excess reserves overnight. And then, of course, it causes volatility in the markets depending on what's being said by the Federal Reserve. If there's anything that's been that deviates from what the expectation is from the FOMC. Let's say, for example, if they're expected to talk about maybe rate cuts for September, and they decide to deviate from the expectation, talk about rate cuts happening sooner or later, then those are the kind of things that can affect the markets, and then future sentiment and pricing in and speculation as well. This is the thing. So we're not only looking at the figure itself. What matters equally as much is the statement. And usually when the rates come in as expected, then everyone's eyes flick to the rate statement to see what has been said and why the market might have moved in the way that it has moved. So that's the difficult thing about it, is being able to understand what the message has been delivered by the Federal Reserve and whether it's something that's new or not, and whether it's something that you can take action on. All right, so the other simple thing as well, and particularly during the initial hiking phase of the central bank, it can also influence other central banks to follow in the rate path, i.e. what we'd seen last year and the year before that is in the strength or in the amount that the central bank would hike by. So if the Federal Reserve wanted to hike by 50 basis points, then you would have other central banks that would follow in the lead of hiking by 50 basis points or taking stronger monetary policy action with their decisions. So how does it affect the markets? Simple with the currency. When the figure and the monetary policy statement, if the figure is higher than expected, then usually that's bullish for the dollar, particularly if you have a statement that is very hawkish, i.e. they see the economy performing in a strong way, inflation is still too strong, or that rates may need to stay higher for longer because inflation isn't coming down fast enough to meet their 2% goal. Those are the kind of things that would give some or add some bullish momentum, or could add some bullish momentum to the dollar. Then on the flip side, we have the stock market. When we're looking at, particularly, we're going to be focusing on the stock indexes. Usually, whenever you do get a rate that is raised, let's say that for whatever reason, at a future rate decision, the Federal Reserve is expected to hold rates, but then they decide to cut rates, so deviating from what the expectation is, and they provide a dovish monetary policy statement, that would be seen as a bullish sign for the stock market, because the things that, of course, businesses don't want rates to be high for too long, and they would ideally want the Federal Reserve to quickly finish with their rate hiking cycles, and then they can continue doing their business and also have to pay less for borrowing money from commercial banks, and then having to deal with the outfall of maybe that there are people that are whose wages might not be high enough to meet the demand for housing or for the basic necessities, and then in turn causing a workforce issue that might make it a bit more difficult in deciding whether to hire more people or to continue letting go of people, or reducing productivity over time to kind of manage a business's finances, so they don't get overblown, or that they don't get affected by any of the other turmoils that the economy might be facing. And then for the bond market, the bond market has been very, very volatile in recent weeks, or the last couple of weeks or so. The reason being is it's the expectation of the Federal Reserve and other central banks that may be keeping their rates higher for longer than what the market would have previously expected. Now, for a rate decision, it's a similar thing. When rates are raised, if the expectation isn't met, or it goes below the expectation or above the expectation, let's go with the above expectation in this stance. If the Federal Reserve decides to hike at this meeting rather than in what some economists are expecting, well, I'd say some, there's only a couple, instead of hiking in December, then what that could do is lead to bond yields seeing a rise in anticipation of rates going higher. Okay. And of course, rates have gone higher, so borrowing costs have also gone higher. And then anyone investing into a bond is then given more in return for holding on to government debt. So then that will lead to, over time, as said, higher bond yields and lower bond prices. But if the Federal Reserve decides to take a surprise hike today for a 25 basis point instead, that might mean that they might have to do less work in the future. Although they have cited that the bond market, if yields are already quite high, that means that they might not need to do any more rate hikes instead, and let the bond market and let the treasury market do the job for them instead, if borrowing costs continue to soar. So where is the economy at the moment? So GDP third quarter is at 4.9%. Did very, I mean, it's not excellent, but it is much better than where it was in the second quarter. Inflation was unchanged at 3.7%. That's the CPI year on year. And the core CPI was at 4.1% compared to 4.3%. Remember, the core inflation data is what the Federal Reserve likes to focus on, particularly the PCE price index, because that gives a measure of the US economy overall rather than just the urban areas. The PCE price index year on year was at 3.4% compared to 3.5%. Core PCE price index at 3.7% compared to 3.9%, and the consumer spending month on month was at 0.7% compared to 0.4%. All right, non-farm payrolls, which came in hotter at 336k compared to the prior of 227k, which is what the prior was revised to. ISM manufacturing PMI, which we've had today, was at 46.7 compared to 49. The services PMI 53.6 compared to 54.5. The UMich sentiment survey is 63.8. That was the final read compared to the prelim previous of 68.1. The 1-year inflation expectation rose to 4.2% compared to 3.2%, and the 5-year also rose to 3% compared to the prior read of 2.8%. Unemployment costs, which we had this week as well, rose to 1.1% from the prior of 1%, and also the forecast was for 1%, and that led to an appreciation in the dollar index, in the Dixie, and a depreciation within the stock indexes. In thinking that, of course, if the Federal Reserve is also focused on wage inflation data, wage data as well, and wage price pressures, that was also another thing that gave a little bit of a kick in a bad way to the stock indexes. But overall, it's only a 0.1% increase, albeit still maybe not as favorable, maybe not still good for the Federal Reserve, but it might not be as bad as some people might make it out to be. And the Federal Reserve will probably talk about it, but not make any real light of it as it affecting its decision with the rate decision. Now, the previous FOMC statement that we had on September 20th, more or less quite concise. That's how they usually are, the statements for the rates. They're very concise. It's about a page, and that's all you get. And more or less, you get a repetition of what's been said in the past. It's just some key things that you just need to try and keep an eye out for, and try and see what differences that there might be. But just some of the other things to highlight. They said that recent indicators suggest that economic activity has been expanding at a solid pace, and job gains have slowed in recent months but remain strong. And the unemployment rate has remained low, and inflation remains elevated. And they also said that tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. So this is good for what the Federal Reserve wants to happen to the economy, or needs to happen to the economy, for it to try and keep that dual mandate of seeing a robust labor market whilst bringing in inflation down. So far, albeit it was one surprise bit of data from the non-farm payrolls data that we had last time round, so far the Federal Reserve seems to be doing what they've, to try and achieve their goal without putting the US into a detrimental position, or in a very detrimental position where the US isn't going to be able to recover for a while. So this is also another thing that caused the risk assets to see a depreciation, is because of what the Federal Reserve had mentioned in their summary of economic projections last time round. The bit that I've highlighted in yellow there is their federal funds target. So in June, they're expecting the 2024, or the rate to be in 2024 at around 4.6%. That was increased to 5.1%. And that gave another signal to the markets and the speculators that the Federal Reserve is going to hold rates for longer than what market participants would have expected them to do. So we're probably not going to get commentary about where they expect the federal funds rate to be. That's already done in the summary of economic projections, but it would be said in form of words that they may need to keep rates higher for longer. It depends on whether they say when. If they do say when, and it's shorter than September of what markets are expecting them, when markets are expecting the Federal Reserve to pivot. If it's before September, did I say December? No, it's September. If it's before September, then that could lead to a bullish reaction potentially for the stock indexes. However, if they don't really mention a time, and they kind of repeat that they might need to keep rates higher for longer, then you might not really see such a strong reaction. You might get a bit of a whipsaw reaction and attention to that point there, but if it's been said in the past by the FOMC members, and the markets have already been speculating on how it could affect the economy and have speculated in the markets, then the reaction might not be that great. So that's something else to be conscious and aware of, that if there is that repeated rhetoric sometimes with rate statements, then you don't really get such a big reaction the next time round, or maybe not even at all, depending on if it is like for like. So the Fed minutes on October 11th. So they said the vast majority of participants continue to judge future path of the economy as highly uncertain. And risks included longer lag effects from financial tightening, the effects of union strikes, slowing global growth, and continued weakness in commercial real estate. Several participants noted that balance sheet runoff could continue for some time, even after rate cuts begin. And participants still saw below trend growth and softer labour market as necessary to restoring economic balance. And then many participants noted that data volatility, potential data revisions as supporting the case for proceeding carefully in determining the extent of additional tightening. So one example being non-farm payrolls was stronger than what the economists were expecting. So those kind of surprises within the markets can cause or can lead to a shift towards a direction, maybe not a total shift, but a heavier leaning to maybe keeping rates higher for longer, or even the odds of maybe raising rates again this year. Maybe not at this meeting, but at the last meeting of the year in December. Fed members, we've got there's quite a bit, so I'm going to probably get to the hour on this. So Bourbon said that she expects progress on inflation is likely to be slow under current conditions, suggesting the need for even tighter policy. That was said on September 2nd, 2 days after the last rate decision. And then Fed's Daily said that it's unlikely we will be at 2% inflation in 2024. Goolsby added that it feels like rates will have to stay higher for longer than markets had expected. So again, these comments are already transmitting the view that the Federal Reserve isn't going to pivot at the time that the market is expecting them to pivot, and they might decide to cut rates after or post September or late in December, or maybe even to the extent in 2025. Fed's Kashkari said that declining inflation next year might justify backing off the federal funds rate to stop it from getting tighter, and the yield curve is uninverting is not necessarily bad news, and it could be good news. So again, as I said, if the yield curve is uninverting at that point, then those comments were made back on September 25th. Then it means, as I said earlier on, it means the Federal Reserve has less work to do in tightening policy themselves. If the bond market, of the treasury market, is already doing the job for them. Although you may face that short-term volatility within that time period, it doesn't mean that it's going to have a long-lasting lag effect on the rest, on the economy for the foreseeable future. Okay, carrying on. Let's see. So Fed's Bostic said that late 2024 is possibly a time when the Fed would cut rates. And Fed's Messer said that her forecast shows rates are within one hike of a peak. And then finally, Fed's Powell, who actually moved the markets off of his comments, what he said here. Just a quick question. Are you guys seeing my stream clearly? Is it nice and clear? It should be. I hope it is. Yeah, no. It's all clear. Let me know if you can't, if anything seems blurry to you. If it does, then, well, probably stick with it. Can't close the stream now. You gotta go with it, son. All right. So yes, as I was saying, so Fed's Powell, he said that it may, on October 19th, said that it may be that rates haven't been high enough long enough. And off of the back of that comment there, we got this. This is the market reaction. So you've seen that the dollar had strengthened off the back of that. The S&P 500 had weakened off the back of that as well. And that was probably one of the first times outside of of the last meeting that he more or less He reiterated what he said, that rates will need to stay high for longer, but that it may need to stay higher for longer. Again, it sounds like it's the same, but at the same time, it's not. So if I kind of go back to it, so he said that it may be that rates haven't been high enough for long enough. Okay, and saying compared to what he previously said, that rates may need to stay higher for longer. It sounds, like I said, it sounds different. But oh, on your mobile it's blurry, but on desktop it's good. Yeah, you might need to just double check your settings on that. Make sure it's on the highest setting available for you to have a look at. So although it may seem like the same comment going back to this, it still did move the markets. That it did give that push, that extra bit of volatility at that time. Okay, moving on. So this was the summary, or this was the CME Fed Watch tool. It's very useful in times of when you might be uncertain of what the markets are expecting the Federal Reserve to do. But this being yesterday, so more or less the odds of no change is more or less priced in. And so you earn 1.8%, doesn't really matter that much. Unless you start to get, when the CME Fed Watch tool matters, is when you start to see numbers of about 50 or about 50% on either side, or there is, there's like 40-60 split. That's when the volatility from the rate decision, depending on which way it goes, can pick up more. So it's always useful to keep an eye out on what the CME Fed Watch tool is showing you and what the expectation is. So again, if the Federal Reserve deviates from the expectation and decides to maybe, let's say, hike rates instead, taking it to a new target level, okay, then that would be, of course, that would blow out both of these expectations. I'm kind of surprised somebody was looking for a rate cut of there's a 1.8% chance. Poor them. Yeah. But yeah, so keep an eye out on the Fed Watch. Keeping an eye out on the Fed Watch tool is always very useful. So this is what the investment banks are looking at. This is showing you here Bank of America and Barclays are expecting a 25 basis point hike in December. And the majority of the, or actually all of the investment banks and the major investment banks are looking for the Federal Reserve to stay steady and not to hike rates instead at this meeting. So everyone's on hold. Besides for the year, besides a couple of investment banks who are looking at a 25 basis point hike in December instead, Bank of America and Barclays, of the notable major investment banks. So this is also one to talk to. So talk about it as well. So you had the S&P that made their comments recently this week as well, expecting the Federal Reserve to leave interest rates at elevated levels until inflation shows a meaningful move down, and that's more or less expected from the rest of the market. But this is what I wanted to kind of discuss in a bit more detail, in particular about the yields. So from the Wall Street Journal, they, in an article, talked about how some economists say that the rise in yields term premium, or what traders demand in return for holding a bond, or the interest that they get for holding a bond, is worth 2 or 3 rate hikes, according to economists. So this is what I mean by the Federal Reserve saying that the bond market, or the treasury market, or the treasury is already doing the job for the Federal Reserve in that regard there. So you had economists at Deutsche Bank that estimate that the run-up in yields since September, financial conditions have tightened enough to reduce economic activity by 0.6 percentage points over the next year, which economists say is equal to roughly 3 interest rate increases of a quarter point each. Then you also had some other investor sentiment as well, where investors might be willing to accept a negative carry for 6 months, i.e. getting less for the bond that they're holding on to, that if investors might be willing to accept negative carry for 6 months if they think that yields might subsequently fall because the Fed will cut rates on the economy weakens significantly. But the prospect of 12 or 18 months of negative carry would make investors more reluctant to own longer dated securities. So you had comments from Morgan Stanley saying that the starting point for this bond market sell-off was how the Fed had been guiding investors to think about the most likely outcome for the path of its policy. As according to Morgan Stanley's Hornback, who's the global head of macro strategy at Morgan and Stanley, he said that investors have just not wanted to pay the negative carry. So there's so the government. Remember, the government is the body that provides or puts these bonds out to the market. And if there isn't enough interest, or if the demand is weaker than what the government would have expected to be, and particularly what the market's expected to be as well, then that will lead to yields having to go higher to try and attract more, attract those investors into jumping into government debt. So there's also that factor too. But you can't force investors to invest in a government bond. So the only thing you can do is raise the yields and then the prices go cheaper. So if you're not sure how bonds work, whenever the yield is raised for a bond, usually what happens is the bond price also goes down in value, making it cheaper and more attractive for an investor to jump into. That's the whole point. Usually that happens when the economy is doing really, really well, or the interest rates have gone higher as well. To of course with the yields naturally going high off the high interest rates. So that's a difficult line to kind of walk for the government too, is as to how high do they go if if the economy, let's say, could maybe dip its toes into a recession or a small recession, or see a loss of growth over the next year or so. Like I said, what Deutsche Bank were talking about, that the run-up in yields in September could equate to about 0.6 percentage points a reduction for the economy over the next year. I said, which equates to roughly 3 interest rates hikes of a quarter point each. Okay, and then the market pricing. We're still doing good for time. Got about half an hour or so. So September 20th, posted the FOMC rate decision. We had Fed swaps that priced in low rate cut odds for 2024. Fed swap shows traders pushing back the first rate cut to September. Now, for whatever reason, let's say one of the questions to Powell, or in the let's say in the statement that is mentioned, that the Federal Reserve decides to maybe think about cutting rates sooner, which is highly unlikely. They'd probably show that in the summary of economic projections rather than say in the statement. Then, as said earlier on, that could lead to a bullish reaction from the stock indexes and the stock market overall and the risk assets. But the most likely scenario is that they probably will mention that rates need to go high for longer. Powell in the press conference will probably not entertain the idea of when the Federal Reserve will decide to cut rates. And you probably get those sort of comments from other FOMC members, like you've had from Fed's Bostic, not really giving an exact timeline, but giving a rough estimate of when that could happen. October 6th, you had Fed swaps price in higher odds of a rate increase this year, and swaps shift full pricing of a rate cut to September from July. Now remember, that was off of the back of the non-farm payrolls data. So again, stronger than expected data shifted sentiment enough to push the first rate cut from July to a couple of months ahead into September. So remember Friday when we have the non-farm payrolls data, again, it's going to be very important to see how big of a deviation that there was from what economists were expecting. And the bigger the deviation, the more speculation that there will be within the market. October 19th, Fed swaps trim odds of an additional interest rate increase, and October 27th, post the PC inflation data, US short-term interest rate futures rise after inflation data, and traders betting no more Fed rate hike. So again, so what you want to, the reason why I'm going through the history of it, it's important to understand how traders have felt, what has been the sentiment over time, and how has it built up to this point. Okay, so then you have a better understanding of it, and then when it does come time to let's say the next this rate decision or the non-farm payrolls data, you have an understanding of what the sentiment is. And although that doesn't mean you're going to know how strong the reaction is going to be or which way it's going to go, you will have a better understanding of the key thing, sentiment. All right, so this was the last rate decision as well that we had, and you'll see how the S&P 500 doesn't like it, and you see that move towards the downside. So this is about, I can't see the red, it's about 3 seconds. Yeah, about 3 seconds before that rate decision came out. Okay, so past, looking at September 20th, so you can see there, the decline on the S&P 500 off of the back of off the back of the sentiment that the Federal Reserve is looking to keep rates higher for longer. Kind of skip ahead. We can see that it kind of held. It was kind of being continued to be held down after about 10 minutes of trading. Although you did see that bit of the pullback there from the market. Okay, so we can see that. So this is, again, it was the SEP, the Summary of Economic Projections, that caused this market reaction, because the market wasn't really expecting or anticipating that the Federal Reserve would would keep their rates higher for longer and into 2024. As I said, it was at 4.6% for 2024. Then they had seen it was at 5.1% for 2024. So a longer time frame for when the Federal Reserve would likely want to pivot. Although it wasn't very clear as to when that would be, the obvious thing was rates were going to be high for longer. That's not going to be good for the economy and the businesses and consumers. Hence, you had seen this reaction from the markets there. Okay, so let's get out of that. Let's go through the deviations in a bit more detail. Let's kind of understand what it's seen the biggest moves and why. Let me scrub it up here. What we got? Yeah, there we are. Okay. Here we are. So just so everyone's clear what they're seeing here, this is the deviation sheet, and what it shows you is how big has the market reaction been to, let's say, a statement released by the Federal Reserve or rate decision or an economic release. And in particular for the interest rate decisions, what I do is I provide the sentiment here on the right hand side, because interest rates are more nuanced. It's not just a figure. It's the comments that we need to be aware of. And this is completely free. Don't forget, if you've liked the video, if you've enjoyed the video so far, and you haven't liked the video already, give that like button a hit, subscribe to the channel, and get the word out there. But as I was saying here, so this is showing you how the markets have reacted to not only the interest rate decision, but also what was the sentiment surrounding it. So just to make these numbers clear, so of course this bit here just showing you what the actual figure is and what the forecast was. Okay, and this column here shows you the deviation. And in here, which is quite important, is showing you how big was the initial market reaction. Firstly, here, I don't know if you should be able to see my highlight. Yeah, you should be able to see that. So here, this figure shows you the initial market reaction going to the wick of a candle on a 1 minute chart. Okay, so you'd seen about 60 ticks down initially on the S&P 500, and then the brackets in black, that shows you the movement 10 minutes after the economic release. ETN Powell, Powell is due in about an hour or less than an hour. Can you guys see where I'm highlighting though? Can you see that color? You should be able to. The blue highlight bit that I've done here. Okay. Yeah, it's on the deviations and ranges Excel sheet. So you probably see which box I'm selected to. This is also another cool thing with the ranges and deviations. You can see me edit this live and in real time. Okay, so probably after about a while, because I've been speaking for ages, you'll be able to see me editing this and getting all the data in. So let me get back to this. So the first figure in brackets here, the black brackets, shows you the movement 10 minutes after the economic release has come out, going to the end of the candle. Okay, and then one of the things I thought would be important too is to see how long does the market reaction last for. When does it start to peter off, or does it continue on its monster run, if there is a monster run? So this figure, or this brackets, or the brackets here in blue, which you're probably not going to be able to see on the stream, but this last figure in brackets here represents the movement 30 minutes after the economic release or data or statement has come out. Okay, again, that's going to the end of the candle, all on a 1 minute chart is what I look at there. Okay, so we can see here on the S&P 500, you can see that there was the initial move down. It had a stronger reaction compared to the last three rate decisions, 3rd of May, 14th June, and July. And also the reaction did continue, or did try to, after about 10 minutes of trading, did try to continue going down, but it didn't move down by that much. So if we're comparing the 60 tick move initially down, and then after about 10 minutes of trading, it was down by an extra 4 ticks. Okay, and after 30 minutes of trading, it was down by 51 ticks. So there was a bit of a pullback. Not a strong, huge pullback, but there was a bit of a pullback nonetheless. So even though with that slight surprise with the expectation of rates being high for longer, you didn't get that continuation of the momentum towards the downside for that long. And you can compare to the other areas though, on the NASDAQ, where it's 238 ticks down, and after about 10 minutes of trading, it's 251, 30 minutes, about 179. So they don't really, the initial moves don't really hold on, let's say, for the rest of the for the trading period. Just off of the first 30 minutes or so, you can see that it kind of takes in the decision and then starts to try and make its way back instead. So if we're looking at the biggest currency moves, now of course with the Bank of Japan, what they did this at this meeting, and which will probably keep it as the currency pair that's going to see the biggest reaction, is that they didn't they didn't decide to up their reference rate, which would have gone to 1.5%. So the 10-year yield at the time of the rate decision was at 0.999. I think it's at 0.995%, and the limit for that is 1%. But because the markets were expecting them to maybe change that to 1.5%, and they didn't, the yen took hammering, a big old beating from the markets off of the back of that comment that was made there, and the continuation of the Bank of Japan saying that they will continue to ease if need be. So the yen in this case scenario and in the majority of past scenarios has seen the biggest market reaction overall. So that's what we're going to be, well, of course, keeping an eye on one of those, but also not to kind of put aside the other areas too, with cable or the euro dollar. Those are the other two currency pairs that you can see here. I've kind of done it. Yeah, so you can see these other two pairs have seen did see a decent move from the rate decision last time, but still the dollar yen had seen the most amount of movement pip wise compared to the other currency pairs. But even so, although the market moves were after 10 minutes stronger, after 30 minutes you can see it kind of goes back to what it was initially, what was the initial reaction. All right, so if we're looking at the bond market too, I also took down Bitcoin as well here. Just interested to see how much it moved by. Bitcoin, the futures ain't that fun, to be honest. But hey, if you enjoy it, you enjoy it. So the 2-year bond price, of course, being the most sensitive rate decision out of the bonds that are available to the market, had seen the most moves, and that's going to be obvious, with 31 ticks down initially, and then after about 10 minutes of trading, about 36. But this is the key thing that I wanted to, I've already said this before, but here in the sentiment column, talking about what caused the markets to react in that way. So again, I'll go over it, is that the Fed projections imply a one more 25 base point rate hike this year and 50 base points of rate cuts in 2024 versus 100 base points of 2024 rate cuts compared to the June economic projection. So overall, the S&P was more hawkish than expected, which led to the decline in stocks and repricing for rate cuts next year. So let's say we get something that's similar to, of course, we're not going to have the S&P to have the added volatility to the markets. We're more going to be relying on, does the Federal Reserve repeat what they've already said by what the members have said and what Powell said before? Do they repeat by saying that there is a need to keep rates higher, where they are restricted levels for longer, or do they say that they may need to do one more hike, but they'll be data dependent, which will be confusing to the markets if there isn't really a clear outline of. Okay, there would be an outline of focusing on the same points of data, inflation and jobs and wage price pressures. So, it might be a boring rate decision if that were to occur. A not boring rate statement would be if they were to talk about rate cuts next year. Would definitely spruce up some of the action and that volatility as well. So let's say if they expect GDP or if they expect the economy to fare worse than what they might have expected it to do in the past, then that could add some dovishness to the markets, or provide some dovishness for the markets. But I think one of the possibilities that will be presented within this FOMC would be that they'll talk about, or potentially talk about, rising yields, maybe doing enough of a job so that the Federal Reserve maybe doesn't have to do any more. And then that, in a way, could provide some more, although it may seem hawkish in a sense that the yield market is quite strong, but it's more dovish because it means that the Federal Reserve doesn't have to do that much. It doesn't have to do that much more work to bring the economy or inflation to where they need to be, and bring the let's say the economy to where they would be comfortable with it. So the economy isn't overheating, but it's not also seeing a huge decline in productivity or growth. Okay, so that is the deviations. So bear in mind, with the deviations sheet, this is completely free, right? You don't have to pay for anything. You don't have to give your credit card details or anything like that. All you got to do is sign up to the MACROACE mailing list, which is here. That's in the chat there. Now, remember, with the MACROACE mailing list, you don't just get the deviations to all the different economic releases that we would have covered or may have been keeping an eye on, but you also get an email on every Monday, okay, which will give you a short rundown of what to expect for the week ahead in Asia, Europe, and the US. That's not very detailed. There's not a lot of information there. It's supposed to act as a refresher. And then here is where I talk about go into detail about the live streams, or about the topics that we're going to be covering in the live streams instead, unless there is something that's very important to kind of go over. Then in that situation, will be you might get more in the email, but rarely would you. As I said, it's more of a refresher. So if you're expecting line graphs and charts, you're not going to get that. Just to kind of temper your expectations, because I talk to you guys in more detail here, and I rather prefer not to read an essay. That's my kind of form of learning, and that's how it works for me. And I enjoy it. I like that. I like that way. All right. So as said, that's completely free. You get the to get access to the deviations sheet, once you've subscribed, you'll get an email Monday morning, around Monday in the afternoon, as everyone else would, whomever's or whoever subscribed, and you'll be able to get access to the different economic releases that we have here, all in one place to be able to have a look at. You will see, once you've seen the deviation sheet, you might realize that there are some releases that haven't been updated, purely because they've either not had that much of a market reaction for a while, or it's all their releases that may have mattered initially, but are not the focus of the markets that much anymore. So I was looking at ADP today. The market reaction was quite sparse, to be honest, because it fell on the same day as the FOMC. So the markets were more focused on what to expect from the FOMC rather than ADP. And of course, you have non-farm Friday, so there's that to wait for later on in the week. It's still useful for what kind of a reaction non-farm payrolls could provide, depending on whichever way the figure goes. But yeah, okay. Right. That concludes that little bit there. So again, as said, this is completely free. All you got to do is sign up to the MACROACE mailing list. You get an one email a week, every Monday morning, from me, giving you a short summary or refresher what happened in last week and what to expect for the week ahead. More so, link to the live streams, and also the link where you would click and see the deviations, a live sheet as well, which will be yours forever to keep. Okay. All right. So let's close that, and let's get our charts set up. Get everything else set up. We've got about 10 minutes left. What I'll do is I'll talk to you about FinancialJuice, and then I'll pop out for a little bit, and then I'll come back in to a lot of room. All right, there we go. I'll put the link for you there. Carl Victory says, "What's the direction for the dollar for FOMC? Of the dollar for FOMC?" Well, it depends. If they're very hawkish in their monetary policy statement, and they say, let's say, for example, an example of what could lead to dollar bullishness is if they say that rising yields are helping with the Federal Reserve to do their job, but it might not be enough. That could provide some worry to the markets that the Federal Reserve may still do that one hike in December rather than no hike at all for the rest of for the next month and until they decide to cut rates or pivot next year. So that could be one scenario that could provide a direction for the dollar. Not saying that's a certain, but you've got to be prepared for anything. So any different scenario. What else? Or on the flip side, you don't really get that much from the statement, and you just see a flash in the pot or in the pan, flash in the pan of a bit of a whipsaw here and there for the whole market, and then you're reliant on what Fed's Powell says. And if he doesn't really say anything new or anything surprising, if he doesn't mention rate cuts, or if he does, let's say if he does mention rate cuts in the press conference, then again that would add some volatility. If he doesn't, and if he does to repeat the rhetoric that they're not thinking about rate cuts at this point, that's something that they're still data dependent and they've got to get to their 2% inflation target. Hey, why don't I do the press conference of Powell? Everyone knows the script by now, or should do. But yeah, those will be some of the things to look out for the dollar. So it's not really, you can't really say for certain which way the dollar is going to go. You've got to take in what the statement says and then make your own informed decision. Or it's totally up to you. You just go blind at it and just run on see what the market, you could go with what the market reaction is. But yeah, that concludes that bit there. So Financial Juice is where we're going to be looking at the headlines, some of the headlines that are going to come through. And of course, on Financial Juice, you have live real text, or you have live real-time voice and text service that's provided to you. So you have your live voice feed here of the global news, or the news that's going to move or can move or potentially move the markets. Okay, all in one place. So here you have your voice feed, a live voice feed in real time, and you also have your news feed here, your text here. Again, all of this in live and real time with no delay at all. And on the left-hand side here, you have your economic calendar as well of the upcoming economic releases and events. So everything's all in one place, and particularly as a day trader, you want to be able to keep an eye out on what's going on within the world, or what's been said by if somebody has said something that's going to cause the markets to move in a certain way. That's the whole point of having a live voice and text service, is to be able to stay up to date and be on the bleeding edge of news. Okay, that's the whole point. If you don't agree with that, that's perfectly fine. Whatever works for you, go ahead with that. But if you're feeling interested, you can try out the free version or the live version of Financial Juice. The live version of Financial Juice, I did actually, let me pin that. No, it's already there. Yeah, the live version of Financial Juice. Although there may be a delay, there are adverts that play. If you've never come across a live voice and text service, what you're trying to focus on is how can a voice and text service become part of your day trading strategy. Okay? This tool or this newsfeed is made for the day traders to highlight the potential market moves that could occur from an important headline. Sorry, let me rephrase that. Giving you important news that could then impact sentiment and also the markets as well, or has already impacted the markets there and then in real time. GoPro, is it not working? Oh no. I'll have a check with our dev and see what's up with that. Make sure, So if you've signed up to, if you're going to sign up to FinancialJuice, make sure if you've, once you've created your account, you've gone to your email and activated your account there when it asks for you to activate it or verify your account. Then go back to the news feed and just log in. Just make sure you're still on the site when you're verifying your account. Also, what I was going to say is that if you do decide to go for the now here's a special offer that we have, right, for the pro version of FinancialJuice. So if you want to stay up to date with the latest and be on the bleeding edge of news, right, then you can sign up today and get our special offer of FinancialJuice Pro for a year's worth of our service for 1 month. Okay, that's $99 instead of per month. You can get that for a year, and you can save 92% on that offer with that offer there. So again, you can click on the link there on the FinancialJuice in the chat, and then where it says FinancialJuice Pro, you'll say Go Pro there. If you click on that link there, you'll have the offer there again. So let me reiterate that. So if you want to take the opportunity of the pro version of FinancialJuice, make sure before you do that you have an account on FinancialJuice on the live version and you verified it. Okay, otherwise then that will cause issues. We're trying to get you signed up and you're like, where's my account? Why can't I see my feed? Why is it not pro? Just make sure you've verified your account and you sign up to the live version. This is your chance to sign up to the special offer and get FinancialJuice Pro for a year's worth of our service at the price of 1 month. And you can save 92% save over 92% on that there. Okay. All right, so we're surely expecting the rate decision. We've got about a minute and a half. I am going to get my TICKSTRIKE up and ready. Whew. Really did go to the hour. Man. Okay, there's TICKSTRIKE up and ready. So not only do we have to focus on the rate decision, but we also have to focus on the statement too. So if it takes me a bit of time to kind of go through it, just bear with. There might be something completely new that I need to kind of digest and then understand. Whoops. So all right. So looking at gold, looking at the dollar yen. Looking at the S&P 500 at the bottom. There we go. All right. Let's see what happens. Let's see what the Feds say. These rate decisions are always difficult because the statements can take a little bit of time to understand what's being said, and then that can lead you to taking a decision before you'd actually want to take a decision. Okay, so about 20 seconds to go. Jamie, you got to pee? Oh no. Use that energy. Use it. All right, 10 seconds. Let's see what it does. No change as expected. Fed will continue bond holding reduction as previously planned. What else have we got here? Credit conditions are likely to weigh on economic growth. Okay, what else? Sorry, I'm going to go silent here. So just as I'm saying this, seeing that the move towards a positive move on the S&P. Towards the upside, and the decline on the Dixie. Okay. So they repeat that they're determined in determining the extent of additional policy firming that may be appropriate will take into account a range of economic factors. Trying to see if they've mentioned anything about the yields here. Okay, there isn't anything new that I can see. So US short-term interest rate futures add to early gains as traders bet Fed rate hikes have ended. Okay, so the repetition and nothing new is what has led to the stock market, or did lead to the stock market seeing that initial bit of strength. Now we're going the other way instead. Inflation remains elevated. Policy setting committee strongly committed to returning inflation to 2% target. Tighter financial credit conditions are likely to weigh on economic activity, hiring, inflation, but to the extent of the effects remain uncertain. So a lot of this is repeated. You're not really seeing a lot of a reaction, or you're seeing more of a whipsaw here from the markets. Okay. All right. So let's do some measurements here then. See what we're dealing with. Okay, still see that a little bit of the buying pressure, but I said it's very mixed. Right, measurement time. So it's about 39 or 37, 38 ticks towards the upside. Okay, let's look at the dollar yen. I just make sure I got the right time on that. Yeah, that one. Okay, let's see. So there wasn't that much. There wasn't that much that was really going on with it. Okay, that's about 21 pips towards the downside. Okay. Let's see. What have we got in gold? I might need to restart gold here. Okay, right, there we are. All right. Golds are about 43 ticks up. All right, so mixed reaction there. Not as big as it was last time round with the last rate decision. Of course, at that point we had the SEP as well at the same time, which gave that added boost or that added volatility. This time around we don't. It was a bit of a boring Fed. And you got that whipsawing reaction that is occurring now. Let's look at the bond futures on the ZT, so 2-year bond futures. Let's see what we got. Oh, no, hold on. Right. Okay. That's about 18. So yeah, again, not big, not as big as last time round, with the market reaction. So a little bit of a reaction to more or less the Fed repeating what it said last time, and that's why you'd seen traders. Okay, wow, all right. Traders of short-term US interest rates add bets the Fed will start cutting rates by June 2024. So that's jumping from September to June. Before that, before September was at July. So now it's gone to June 2024 instead, with the expectation. Okay, let's see some of the other headlines too. Short-term interest rate futures at early gains as traders bet Fed rate hikes have ended. Interest rate futures see chance for further Fed rate hike this year falling to less than 20%. Okay, so yeah, more or less expecting no more rate hikes at all. But other than that, yeah, not fun. Not fun there. Nothing really to play with, to be honest, after having read through the rate statement. So it's, yeah, a no-go for me. All right. So don't forget, tomorrow we have the Bank of England interest rate decision. Again, they're expected to remain pat. They're expected to keep their rates on hold, as well as the Federal Reserve has done. So also don't forget, if you've liked the video, subscribe. If you've enjoyed the video, give it a like. Subscribe to the channel and also get the word out there. Get the word out there of the good news, my brothers, of MACROACE, if you found the information useful. If you didn't find the information useful, let me know in the chat whilst I've got you guys here. Did you find the information useful? Yes? No? What are your opinions? What's what could be improved? What could be changed? Lay it on me. Now is the time to do it whilst I have you in my midst. Sorry. Let me get whilst you guys do that, I'm just going to copy over the link for the Bank of England tomorrow, pop it into the chat for you guys to be able to have a look at. There we go. That's the link for tomorrow. So yes. Let's see. Do you think Sreti Pexi says, do you think the press conference would add anything new or pretty much priced in? Well, with the way the markets reacted here, you're really looking for a surprise from Powell, which he probably isn't going to want to do. He'd usually provide a surprise at maybe in his comments after the presser whenever he does speak next time, but that rarely does that happen. Maybe not surprises, maybe helping those speculators speculate on where the central bank will go in the future, and only then may you see some surprises. Not to say they can't happen in the press conference. Don't completely shoot the press conference off, because he's a dude. And he may slip up, or he may deliberately want to say something to see how the market, not see how the markets take it. That's reckless. Wait, I thought they were reckless. No, I kid. But yeah, so don't blow off the press conference altogether. He may just more or less repeat what's been said. There may be some slight nuances here and there with what's been said in the statement itself, but if the statement has been this vanilla and it's repeated a lot of what's been said in the past, the expectation is that Powell is also going to keep that sort of stance too and repeat what's been said in the past and not really delve into anything that's new, or go in the opposite direction of what markets might be expecting, or defy what markets are expecting. So no, not really anything new. Everyone's saying Grainfo. Mike says yes. Ryan, yes. Harrison, yes. Live stream is always helpful, sir. Julian says yes. All gravy, baby. And awesome. So yeah, that's the link there for the live stream for tomorrow for the Bank of England. TICKSTRIKE. So TICKSTRIKE, if you're unfamiliar with it, or I'm sure some of you guys have come across TICKSTRIKE. If you haven't come across TICKSTRIKE, what it's all about is it allows you to listen into a flow listen into order flow within the markets, whether that be stocks, forex, crypto, futures, ETFs, and ETNs, and internals like the VIX. Okay, now, Abhishek says, can you clarify how the paid version of FinancialJuice differs? Because I'm seeing the live news same as you. Yeah, so remember so the light version has a delay to the FinancialJuice news feed, and there are also adverts that play too. So you might get an important headline that you might be seeing the markets pop off, but then 10 seconds later, you then might get the headline that would have said what that market reaction is. So the seconds and the milliseconds is what is very important to day traders to be able to capitalize on the opportunity. But that's noted. That's noted there. But yeah, so that's the key difference. You also get access to the news desk. You're able to ask us, the analyst here, questions about what's going on within the markets or why the markets are moving in a certain way. And you also have, if you have any other technical issues, then you also get that there as well. We also help you there. You just signed up for the $99 special? Well, thank you very much. We thank you for your support. Live Action says, question, if I take the special 99, can I still get the lifetime deal? You'd be paying for 2 subs if you did that. So if you can go for the lifetime deal if you want to. Yeah, but just make sure you're only paying for 1 subscription, because if you're, because that's how it works. So you select the 1 subscription that you want. If you're already, let's say, if you're paying a monthly sub, just make sure you cancel that before you go on to another subscription instead. Otherwise, you'd be charged for another sub, which you wouldn't want that, and we wouldn't want you to do that. So don't forget to do that. So for the lifetime, same applies. Just make sure you're selecting, you've got 1 subscription, or you paid for 1 thing, and not for 2. So the 99 first, and the next year like 1K lifetime. Let me provide you Amar's email with that question there, and he can answer your questions in a bit more detail. We've actually got, because of the demand, we've actually got a lot of people asking about having questions about what is FinancialJuice about, how do things work, because of the deal. I'll put his email in the chat here. It might take a little while for him to respond to you, but he will get to you. He will get in touch with you as soon as he can. So we've just become very popular. But hey, what can we say? If you like the product, what can we do? Just keep on providing the same thing and make it even better. All right. So let me finish off what I was talking about TICKSTRIKE. If you're not familiar with what TICKSTRIKE is, as I said, TICKSTRIKE allows you to listen to order flow, and or another way to put it is it shows you how strong the buying or selling demand or selling power is, or selling strength is. Okay, so this box here is called the ticker. This ticker box, represents the momentum of buying or selling. A plus figure here shows you that there is buying momentum, and a minus figure shows you that there is selling momentum. Now the number, where does that derive from? What does that number mean? This number represents the sensitivity of this ticker box here. Now 1 is the most sensitive to market reactions. So when there's a lot of buying or selling, when there's a little bit of buying or selling going on, only then will TICKSTRIKE give you a visual and audio alert here. Okay, but if you drag that, you can kind of chop and change to whatever you want to be, whatever you want it to be. But the more you increase that level all the way to 15, then what that means, 15 is the least sensitive to market reactions. So only when there is a large amount of buying or selling that's going on and TICKSTRIKE gets triggered, will TICKSTRIKE give you a visual and audio alert, or whichever way. You can pick and choose whether you want to stick to visual only or audio, or do both. Okay. So again, another tool for day traders to be able to use in their trading day, and to then manage their risk, capitalize on potential trades that they might see depending on the volatility within the markets. So again, here you can see that there, you can see that selling momentum kind of that creeped in here with the bonds. So let's say, and then there is also another part here as well that you can have a little play with, is what we call the lightning bolt symbol, which basically puts TICKSTRIKE on turbocharge. So it's uber sensitive and is 15 levels below 1. So 1 is the most sensitive. 15 levels below that makes it uber sensitive. So particularly if you're scalping the markets. Actually, let me do another one. The bond prices, the bond futures are not really that fun to kind of play with. Let me go into an index. Let's go into the Dow. Oh, no, let's go into the S&P, because you guys can see that there on the screen. Bring that up. Okay, ready for some colors? Then uno, dos, tres. There we go. Right. So it just kind of goes. So as I said, it's uber sensitive to whatever's going on in the markets, particularly if you're scalping the markets. Again, something that I'm not really used to myself, of seeing TICKSTRIKE go turbo mode. I prefer it without the lightning bolt, but that's my way of looking at the markets. You may have a different way of looking at the markets, and of course you will. And maybe the turbo mode works for you, and of course you can chop and change that. Okay, so remember, it's 15 levels below 1, so you can chop and change it between 15 there, making it 1, and 1 being minus 15, let's say. Okay, and then chop and change it to whatever works for you. So that is TICKSTRIKE, and there is a 7-day free trial of that. Of that there. All right, ladies and gents, thank you very much for joining me live. Don't forget to leave a like, leave a comment, subscribe to the channel, hit that bell notification icon, and I will see you guys tomorrow in the morning at 8 a.m. Well, actually 7 a.m. Eastern, 7:30 a.m. Eastern time, 30 minutes before the Bank of England rate decision at 8 a.m. Eastern time. Enjoy Powell's presser, and yeah, I will see you guys tomorrow. Oh, yeah, any questions about transfers or payments and stuff, if you email support@FinancialJuice in the email that I've put in the chat there, your questions will be answered that way there. All right. Thank you very much for joining me. Enjoy the rest of your evening. I am tired now. I want to rest my voice. I'll see you guys tomorrow. All right. Bye.